For the last few years, I feel like we've been waiting for a recession that never quite showed up. And I don't say that to dismiss anyone who made that prediction, because there were plenty of good reasons to expect one. Interest rates went up very quickly. Housing became much less affordable. Credit card balances climbed. Automobile delinquencies up. Business borrowing costs went up. A few banks failed. And for a while, it seemed like almost every economic indicator was pointing in the same direction. Slowdown, pain, probably a recession. But then something strange happened. The economy didn't break the way many people expected. The stock market kept climbing. Consumers kept spending. Unemployment stayed lower than a lot of people thought it would. And even though many households are clearly feeling squeezed, an official recession still hasn't started. So the question is, why hasn't a recession happened yet? If you know, let me know what you think. On paper, parts of the economy still look strong, but when you talk to regular people, you hear something very different. Yes, groceries are very expensive, insurance is way up, rent is sky high. Buying a home feels out of reach for a lot of families. And even people who are making decent money sometimes feel like they're having a hard time just keeping up. That disconnect is what I want to talk about in this video, because maybe the recession was avoided, maybe it was delayed, or maybe the pain is already here, but it's showing up unevenly in ways that don't fit neatly into the official definition of a recession. I don't know the exact answer, and I don't know if anyone else does. But I do think there are several powerful forces that have helped keep this economy moving longer than many expected, namely government spending, the AI investment boom, rising asset prices, a consumer that has been much more resilient than people thought, and beneath all of that, a debt problem that hasn't gone away just because the economy hasn't officially rolled over. So in this video, I want to talk about why the recession hasn't happened yet the way so many people thought it would. Also, what may be keeping the economy afloat, and ultimately, why that doesn't necessarily mean the risks of a recession have disappeared. Because oftentimes, financial troubles show up when people are least expecting it. By the way, my name is Noel Lorenzana. Welcome back to my channel. Be sure to like and subscribe if you like this type of content. If we go back over the last few years, it's easy to forget just how many warning signs were flashing at the same time. The Federal Reserve raised interest rates at one of the fastest paces in modern history. The yield curve inverted, which historically has been a reliable recession indicator. Regional banks began to fail. Commercial real estate came under great pressure. Manufacturing slowed. Many companies began laying off workers. Looking at those developments individually, none of them guaranteed a recession, but taken all together, they painted a picture that looked very familiar to economists and investors who had studied previous cycles. That's why so many people, including myself, expected the economy to weaken. History teaches us that higher interest rates eventually slow borrowing. They reduce investment, cool housing, and make consumers more cautious. That's exactly what central banks are trying to accomplish when they raise rates to fight inflation. The part that surprised many people wasn't that the economy slowed in certain areas. It was that other parts kept moving forward. Housing transactions slowed, but home prices in many areas remained stubbornly high. Manufacturing weakened while parts of the technology sector exploded with new investment. Some companies reduced their workforce while others struggled to find enough workers. The economy wasn't moving in one direction, it was moving in several directions at once. As an accountant, that's something I've learned to be careful about. Financial statements rarely tell the entire story with just one number. Revenue can be growing while cash flow deteriorates. Net income could look healthy while debt quietly builds underneath. You have to understand how the pieces fit together. I think this economy works the same way. There isn't just one economy. There are several thousands of smaller economies operating at the same time. The experience of a software engineer working in AI would be completely different from a first-time homebuyer trying to qualify for a mortgage. A retiree living off investment income may feel very different from a young family struggling to buy groceries. A big corporation with access to capital markets doesn't face the same challenges as a small business renewing a line of credit at a much higher interest rate. When people argue about whether the economy is good or bad, they're often describing their own experience. And that's the part of the reason these conversations become so polarized. Two people can look at the same economy and come away with completely different conclusions because they're living in different parts of it. And that brings us to the next question. If so many areas of the economy have been under pressure, what has kept the broader system from slipping into a recession? I think there are several answers, and they're much larger than many people realize. I don't think there's one simple answer. After much thought, I think several powerful forces have been working together, and they've been large enough to offset much of the economic weakness that many people expected. The first is government spending. The federal government has continued to run huge deficits. When the government spends money, that money doesn't disappear. It becomes income for contractors, workers, suppliers, and businesses throughout the economy. From a purely accounting perspective, one person's spending becomes another person's revenue. That doesn't mean unlimited deficits are a good thing. Every dollar borrowed today has to be paid back, and eventually the interest becomes a huge problem. And we're starting to see that. But in the short run, deficit spending can support economic activity in a big way. Then there's the explosion in artificial intelligence. We're watching hundreds of billions of dollars flow into data centers, semiconductor manufacturing, electrical infrastructure, cloud computing, and software development. Whether AI ultimately lives up to the hype is a separate discussion. Right now, companies are spending real money building real infrastructure. Construction workers are being hired, engineers are being hired, equipment is being ordered, power generation is expanding. That investment shows up in economic activity today, even if the long-term payoff remains uncertain. Another factor is something economists often call the wealth effect. Over the last several years, many Americans have seen the value of their homes, retirement accounts, and investments increase substantially. When people feel wealthier, they're generally more comfortable spending money. They renovate their kitchen, they take a nice vacation, they buy a new car. Not because their paycheck necessarily increased, but because they feel more financially secure enough to make those decisions. Of course, not everyone owns appreciating assets. That's one reason the economy can look healthy in total while many feel like they're struggling. Large corporations have also proven to be remarkably resilient. Many used the pandemic years to streamline operations, invest in automation, and improve efficiency. When borrowing costs increased, they were already starting from a position of strength. Some entered this period with strong finances and strong cash reserves, giving them flexibility that smaller businesses often didn't have. When you put all of those pieces together, it's easy to understand why the economy has remained more resilient than many people expected. Now, that doesn't mean there aren't risks. It simply means there have been powerful counterweights holding the system up. And yet, despite all of that, I keep hearing the same comments from viewers. This doesn't feel like a strong economy. And I think that's because the official numbers and everyday experience aren't always measuring the same thing. And that's where I want to go next. One of the more interesting things about this economy is that two people can look at the same set of headlines and come away with completely different conclusions. One person sees record highs in the stock market and assumes the economy must be doing well. Another looks at their monthly budget and wonders how anyone could possibly say that. In some ways, they're both responding to information that's real. Economic data tends to describe the economy as a whole. Individuals or people experience the economy one household at a time. For many families, wages have increased, but not enough to create the same sense of financial security they had a few years ago. An economy can grow while affordability declines. Corporate profits can rise while households feel stretched. GDP can increase even as fewer people feel optimistic about their own financial future. And there's another factor that doesn't get discussed very often. I mentioned this earlier, but asset ownership in the United States is not evenly distributed. If you own a home with a low fixed rate mortgage, with a diversified investment portfolio and a healthy retirement account, the last several years may have felt a little challenging, but still very manageable. Now, if you're trying to buy your first home, you're carrying debt, living paycheck to paycheck, you probably have experienced the economy very differently. That difference matters a lot. And that's also what they mean when you hear about people talking about a K-shaped economy. It also helps explain why conversations about the economy often become so divisive. People aren't necessarily disagreeing about the facts. They're just describing their very different realities. Yes, the economy has been remarkably resilient. Just keep in mind that history has a way of reminding us that economic cycles don't disappear. Sometimes they just take longer than any of us expected. At this point, I think there are two reasonable conclusions that we can reach. One is that the economy has simply proven stronger than expected. The other is that many of the underlying problems haven't been solved at all. They've simply been offset. Government spending has continued at an extraordinary pace, some even say unsustainable. AI has created a wave of investments unlike anything we've seen in recent years. Consumers have continued spending because many entered this period with savings built up during the pandemic and home mortgages locked in at historically low rates. Others have been simply leaning more on credit cards as the cost of everyday life has gone up. Those forces have provided support. The question is, how long can they continue? History offers some perspective here. Economic cycles usually end when something unexpected exposes a weakness that was already there. In 2008, it wasn't simply that housing prices declined. Housing had been weakening for some time. The financial crisis happened when confidence disappeared and credit markets seized up. Looking back, the warning signs often seem obvious. Living through them is much different. I've listened to recession forecasts for years. Economists like Peter Schiff have spent years warning about excessive debt, government deficits, and long-term consequences of monetary policy. I have a great deal of respect for his analysis, and I think ultimately he'll be proven right. History also reminds us that markets can remain resilient much longer than many people expect. Sometimes being early doesn't mean that you were wrong. Markets have a way of stretching out cycles way longer than rational thinking would suggest. The national debt nearing $40 trillion, it's huge and it matters because debt creates vulnerability. Keep in mind, a system can become increasingly fragile while still continuing to function. There's an old saying that things happen slowly, then suddenly, and I think that's often true of financial markets. The vulnerabilities build quietly in the background, sometimes for years. Then one event changes everything. We've all seen this before. I also believe that debt still matters, that deficits still matter, that interest costs on the debt matter. Ignoring those because the economy has held together so far would be unwise in my opinion. There's a middle ground between complacency and panic. Personally, that's where I'm trying to stay. Prepared if conditions deteriorate, flexible enough to recognize when the facts change, and humble enough to admit that the economy has surprised a lot of very intelligent people over the last several years. Whenever I make videos like this, I try to remind myself of something. The economy doesn't owe us anything. As individuals, we naturally want clarity and certainty. We want someone to tell us exactly when the recession will start, when the stock market will peak, when interest rates will fall, or when inflation will finally come under control. The problem is that economies don't operate on our terms. They're made up of millions of decisions made by households, business, investors, and obviously the government, all interacting at the same time. That's part of what makes them so difficult to predict. Looking back throughout history, one pattern shows up again and again. By the time everyone agrees a recession has arrived, it's usually already well underway. And by the time everyone becomes convinced that the economy is unstoppable, a surprising amount of risk has often been built underneath the surface. That's one reason I've become less interested in making forecasts and more interested in understanding the conditions that exist today. Right now, I see an economy that has been far more resilient than many have expected. I also see record levels of government debt, interest costs on the debt. I see extraordinary amounts of money flowing into AI and data centers. I see households with strong finances alongside households struggling just to keep up with everyday expenses. Those things can all exist at the same time. Could the economy keep surprising us? Sure. I have no idea whether the next recession begins this year or 3 years from now, but I do know it's coming. With that being said, it's more important now more than ever to get your financial house in order. That's something you can actually control. History has a way of making perfect sense when looking back, but completely uncertain while you're living through it. I think the best approach is to stay informed, stay humble, and keep making good financial decisions. Agree, disagree, let me know what you think in the comments. And if you want to know the best way to be prepared for a worst case scenario, then you need to check out my video right up here. Making these videos is a lot of work. If you're able to support in any way, that would be greatly appreciated. And as always, thanks for watching and see you in the next video.